there's one thing to take away from my entire experience being a fund manager and running hedge funds is that the most important thing that dictates the direction of asset prices is what the Fed does.
On this episode of Early Bird, Michael Wang, CEO of Prometheus Alternative Investments. Michael joins the podcast today to talk about how investors are adjusting amid the current market volatility, including what to expect as the Fed hikes rates. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you where you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, Mike, welcome to the Early Bird podcast. How are you doing?
Great. Thanks for having me, Stephen.
Well, thank you so much for coming here on the Early Bird podcast. We're going to be talking about how investors are reacting to the current market volatility. But before we get into that, Michael, let's tell the audience a little bit about you and your background. If you could, in 30 seconds, what should the audience know about you?
Sure. Yeah, I spent most of my career in the hedge fund world. I started off as an investment banker doing M&A at Citigroup. After that, I joined a large hedge fund called SAC Capital, worked for a very prominent hedge fund manager named Stevie Cohen for about 5 years.
I know him.
Yep. And billions, right. And helped grow one of the largest portfolios there. And then in 2012, left to join a guy named Jason Karp in launching a hedge fund called Tourbillon Capital, which we grew to a couple $1 billion before I left New York in 2015 to move to LA, where I'm currently to take over the oldest hedge fund still in existence, called Cypress. Cypress was founded in 1969, believe it or not. And I ran Cypress for about 5 years before I left fund management to build my current company, Prometheus.
Nice. So Michael, you have a lot of experience. It's great to have you on here. Let's talk a bit about the public markets right now.
Sure.
How would you describe the public market so far this year?
It's been obviously a very difficult environment for the vast majority of investors, particularly if you are a retail investor and your only sort of options for investment are stocks, bonds, and crypto. Those have all done very poorly, obviously, year to date. So it's been a very tough environment for the vast majority of the population out there.
Yeah, it's been tough. Most investors invested in the public markets, unless you're heavy in energy or some other sector, it's probably been a rough year for you. Seeing that, are you seeing any sort of data out there about how investors might be, reacting to this market? What are you seeing?
Yeah, I get information and data on flows in the market. So net inflows, net outflows, how institutional fund managers, hedge fund managers are positioned, whether retail is buying or selling. What you started seeing this year was, although initially in the year when the markets were going down, you had retail, coming into the markets, putting money into the markets, thinking that, hey, every drawdown is an opportunity to put more money. That's obviously pinched them. Then you saw a period of time, essentially for the vast majority of the year, where retail started to pull back. And what we're seeing on the institutional side of things is that hedge funds are literally running the lowest amount of net exposure to the markets that they've ran since the great financial crisis. And so that's saying something as well. And institutions in general have the highest cash levels they've had in 20 years. So it's literally since the dot-com bubble. And so that really paints a picture. What does that paint a picture of? It paints a picture that institutions and retail alike are very conservative right now. They've gotten punched in the face for trying to buy dips. and each dip has resulted in further dips. And so it's like, you sort of touch the stove too many times, you end up learning your lesson after the third time or so. And so right now, it seems like investors of all sorts are positioned very conservatively, i.e. negatively, which quite frankly is positive if you want to get into the markets now, because everybody is on one side of the boat. And what you're starting to see actually is that companies are reporting earnings and are missing and even cutting their full year guidance. They're actually rallying off of the prints. So that's a sign of a bottoming process, i.e. that the expectations are so low for these companies that are reporting that they're actually rallying on bad numbers.
Oh, wow.
We saw this in 2009, by the way. I remember this very clearly, March of 2009, when companies were reporting their Q1, when companies were reporting numbers. What you started to see in March and April of 2009 is that they would miss badly, horrible numbers relative to street expectations. The stocks would open down 10% and then close up 10%. And that was literally the bottom of the markets in the first quarter of 2009, although we were still in a recession back in those. In fact, we were in a recession in the entirety of 2009, but the market bottomed in March because remember, the market is forward-looking. And so the markets are going to start pricing in a recovery well before the economy recovers.
Yeah, that makes total sense. Michael, you said that investors, including retail investors, are going to react very conservatively. Are you referring to maybe investors taking more conservative type of investments like ETFs, for example, instead of individual stocks? Or are you suggesting, that investors are going to leave the public markets altogether?
It's the latter, and what I mean is that what you saw during the COVID days is that people are at home. They got stimulus checks from the government, and so they had discretionary dollars to be able to put in investing. They started making a lot of money, quite frankly, and then they lost all that over the last let's call it 6 to 9 months or so, and so. What you're seeing now is that they don't have the cash to be buying anymore because they've lost it on crypto, on being long some of these inflated valuation tech names and such. So it's more the latter than the former.
Oh, wow. So it's more people are leaving the markets altogether. And that's, problematic on many levels, I assume, because people, long-term investing can be a benefit for many people. And especially we're in the age where there are numerous investing opportunities, public and private, for people to get involved with. Let's talk about some of the big macro challenges right now that might be playing into that. How much of that is the impact of the Fed raising rates, fears over recession? Are those kind of all in play with investors' decisions to leave the markets?
100%, all of the above. You got Fed, you got inflation, you got recession. I could touch on each of these. If there's one thing to learn from this conversation, in fact, I've been investing my entire life. My parents are day traders, so I've been exposed to this at a very early age. And so if there's one thing to take away from my entire experience being a fund manager and running hedge funds, is that the most important thing that dictates the direction of asset prices is what the Fed does. That's the number one thing above anything else, i.e. If you think about 2009 all the way to essentially 2021, what was the Fed doing? Easing, quantitative easing, very dovish, and they were providing a lot of liquidity into the markets. There is a saying called "Don't fight the Fed." That works both ways, meaning that if the Fed is easing, as they were for the better part of the last decade, you want to ride the markets. Asset prices are going to go up, which is what we saw. However, the Fed pivoted, let's call it in November of 2021. And ever since then, literally to the T, the markets have gone down in a straight line, because what the Fed started doing is they went from being accommodative and dovish to now hawkish and tightening conditions out there. And so don't fight the Fed. Works both ways. Once that started to happen, you saw the markets totally puke, and the Fed continues to be hawkish. So that's one thing to think about. The other thing that you mentioned is inflation. That is certainly top of mind. That's something that's very visceral to all of us. When you go to the gas pump, when you buy groceries, we're all feeling the pinch of much, much higher inflation. And that's a huge problem because we haven't experienced this type of inflation in, essentially 4 decades or so. So that's been a worry. And quite frankly, why is the Fed tightening? Well, they're tightening because they were wrong on inflation. For the better part of 2020, 2021, they thought inflation was quote unquote transitory. They then, in November decided, you know what, we're wrong. In fact, inflation's here to stay, and it's much higher than we expected it to be. And this is the problem, and we need to control it. And we don't mind putting the economy into a recession in order to control inflation. So just note that the Fed's number one priority is to control asset prices, i.e. inflation right now. They are willing to take us into a recession in order to control inflation. And so what the Fed is going to do is this. They're going to remain hawkish until they see a few months of data that suggests that inflation is now under control. Now, here's the positive spin on this, is that a couple things. One is that we're comping against very high inflation numbers from the back half of last year. So remember in the back half of last year, we had inflation up 6, 7, 8, 9%, right? And so, it seems like the quote unquote, the worst of commodity price inflation is behind us, i.e. oil has come down. In fact, most commodities are actually in a bear market from its highs, a bear market being defined as drawing down about 20% plus. Whether you look at nat gas prices, whether you look at cotton, whether you look at soybeans, you started to see some of these commodities come back down. And so in the back half of this year, you could see inflation come down to plus, 7% and 6 and 5 and 4, then, end up the year plus 3%. But remember, it's comping against an up 9 from or up 7 or whatever it was in December of last year. So that's the good thing is that, peak inflation is getting close to coming behind us. That's and good. Once the Fed sees a few months of lower inflation, they're going to start to pivot, And by the way, the market's going to sense that well before even the Fed sees it. The market's going to start pricing in a recovery that the Fed is going to pivot to be a bit more dovish well before the Fed even does become dovish.
That's really good. Good point about inflation. When we return, we'll hear from Michael about how average investors are getting into alternative investments. But first, let me tell you how you can become a more informed investor through Early Bird, our free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. Mike, so today we're talking about how investors are adjusting amid the current market environment that we're in. One of those areas is alternatives, I guess. Could you talk a little bit about, how more retail investors might be getting into alternatives?
Sure. So maybe it's best to define what an alternative is. And the way I always describe it is it's anything that's not traditional. So what's traditional? Stocks, bonds, ETFs. That's traditional. So alternatives can describe everything from hedge funds to venture capital funds to buying and selling artwork to buying and selling comic books. And so alternatives is a whole umbrella that encompasses all these different asset classes. And so why are alternatives attractive, particularly in environments like this? Well, they're attractive for a few different reasons. Number one is they tend to be uncorrelated, or at the very least, less correlated to the broader equities markets. So if you're a retail investor and you're 100% exposed to just being long the S&P 500 or tech stocks, when the market goes down, you're going down with it, and likely further down than the markets. You're not protected on the downside. Whereas if you invest in a low volatility, low net hedge fund, we have those on our platform that are flat to up this year in a market that's down 20%. And so those are very attractive instruments and asset classes to look at and invest in. And then the other reason to invest in alternatives as well is that they could potentially generate much higher returns than just traditional stocks and bonds. So, for instance, private equity and venture capital for the better part of this past decade have been materially outperforming even the S&P 500. And again, private equity and venture cap fall under that alternatives umbrella. Now, however, it's been extraordinarily difficult, if not impossible, for the average retail investor to get access to alternatives. And why is that? Well, the reason why is because of these archaic laws and rules and regulations that, quite frankly, came about in, we're talking about the Securities Act of 1933 and 1940. Archaic laws that prevent the average, mom and pop from investing in alternatives. So until the laws change, it's very difficult for the vast majority to get access to them. But you're starting to see more platforms like ours come about that are lowering those barriers to entry, while still being on the right side of the law, obviously. So there's platforms like ours, Prometheus, where we offer direct access to hedge funds, to venture funds, to credit funds, to private equity, et cetera. You can go on places like AngelList to get access to direct private investments, so startups and stuff like that. We don't do that at Prometheus because we believe that most people in the world aren't investors, aren't full-time investors. Investing is a full-time job. And it's okay to have your own, AngelList account or your own Robinhood account. But if you're an engineer on your computer all day long, you're probably better served putting your money with a talented manager that you found on Prometheus. And we pre-vet all these managers, by the way. They all have amazing track records.
Good. Is your platform just for accredited investors, though?
No. There's actually two parts of the platform. There's the social media / content component of it. And then there's the marketplace for alternatives. So the app is available for anybody, whether they're accredited or not, to download. We are in invite-only mode right now. However, for your listeners, use the code BIRD to get access. You could download the Prometheus Alts app on the Apple App Store and access it and use the code BIRD again to create a free account. It's an entirely free platform. And go on there and start engaging with the pros.
Nice.
So all these hedge fund managers that have funds on our marketplace, they're posting content about what their thoughts are in the markets today in real time. And it's the only place that you can go to without all the noise that you find on like a StockTwits or any of these other social media platforms. It's the only platform where you can engage and learn directly from some of the best investors in the world. So do that. And, generally our marketplace, though, because of the regulations, are generally only available to accredited investors and above. But the social and the educational component, that's available for everybody.
Nice, definitely good to know. Thanks for the offer. That code word is BIRD again, BIRD.
Yep.
Cool.
BIRD.
Cool. So Michael, you laid out some of the benefits of alternative investing, and on Early Bird, we cover not just for commentary stocks, but there's commentary on cryptocurrency and commentary on equity crowdfunding. And I'd personally be lying if I didn't do alternative investing. In fact, if you consider real estate investing as part of that, that's a big part of that. And I'm happy with the results this year so far with real estate investing. But I did want to play devil's advocate a bit. Is this the right year, 2022, given the fact that we have a looming recession? And I know alternatives are great. You should probably have some in your portfolio as long as you speak to your financial advisor, make sure they can help you with that. But given the fact that we might enter a recession, we have inflation right now, is this the year that retail investors should be going into alternatives? Is it a bit maybe too risky this year to go in the alternative realm?
I think it's actually the opposite. And the reason is because right now, retail investors generally have their portfolios just along the market. So they're already down anywhere from 20 to 50% likely, and they experience no downside protection because generally most retail they don't have a big short portfolio to protect them on that downside. But the reason to invest in some of these alternatives is that they can protect you on the downside. So, for instance, we have funds on our platform during June, for instance, markets down 10%. We had funds that were up, and so these are very talented managers. And they can protect you on the downside because they have a large short portfolio. They actually, a lot of them take no exposure to the stock market. They want to run quote unquote net neutral. And so I think it's actually the opposite. The other thing to think about though is if you're worried, by the way, I agree with you. I don't even think that we're heading down, but I think we're probably already in a recession, quite frankly. And then the question is, okay, well, what if I just put it in cash? Well, the problem with cash today is inflation's so high. So your purchasing power is going down. So if you just keep it in cash and you're earning 1%, 2%, but inflation's at 9%, you're losing 7% just by keeping in cash.
Makes sense. Yeah, you make a very good point, Michael. And you're absolutely right about the advantages there. Michael, thank you so much for coming on the Early Bird podcast today, talking to everybody about what the market's currently like for investors and about alternatives out there. Before we wrap up the podcast, I just have one final question, and it's the most important question for today's discussion. That question for you, Michael, is what song could you listen to over and over again?
Oh man, okay, that's a good song. I'm a fan of. What I've been listening to over and over again is Harry Styles, of all people. And I had no idea that Harry Styles was this good. I thought it was just, for teenage, he's a teenage pop singer, but Late Night Talking, that's the song.
Nice. That's a good song.
I had no idea it was Harry Styles, by the way. But I didn't figure out it was him. So he's pretty darn good.
Yep. Good song. Thank you again to Michael Wang for sharing your insights on investing. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.